In our last video, we introduced the concept of buffers and downside protection, and we named a handful of investment vehicles that carry that concept. Starting today, we are going to go deep on each one of those vehicles individually. First up is the RILA, the Registered Index Linked Annuity. Before we get started, what you're seeing is an AI-generated avatar of me, John Wiswell. The ideas, the research, the perspective, all real. We just think this is a pretty cool way to bring it to you. If you have not seen the buffers video yet, go back and watch that one first. It will give you the foundation you need to understand everything we are covering today. Because a RILA is not just a product, it is a structure. And understanding the structure is what separates an informed decision from a confused one. A RILA is a contract between you and an insurance company. Your return is linked to the performance of a market index, like the S&P 500. But your money is not directly invested in that index. You are not buying stocks. You are entering a contract whose outcome is defined by how that index performs over a specific period of time. The duration of these contracts typically come in 1, 3, and 6-year options, and the term you choose matters more than you might think. A 1-year segment gives you the shortest commitment and the most frequent reset points. Each year the segment ends, your outcome is calculated, and you can reposition into a new segment based on current terms. The trade-off is that shorter terms typically offer lower participation rates or tighter caps because the insurance company has less time to work with on its end. A 3-year segment sits in the middle ground. You are committing for a longer period in exchange for generally more favorable terms, higher participation, higher caps, or deeper buffers depending on how the contract is structured. These terms balance flexibility with the improved economics that come from a longer commitment. A 6-year segment is where the contract can really open up. The longer you are willing to commit, the more the insurance company can offer on the participation and protection side. 6-year segments are where you are most likely to see the kind of participation rates that can exceed what the market itself returns, which we touched on in the last video. If you invested $100,000 and the market doubled over 6 years, a participation rate above 100% means your outcome can exceed straight market exposure by a meaningful margin. The longer time horizon is what makes that possible. Now let's talk about crediting strategies, the mechanism that determines how your return is actually calculated. There are several crediting strategies available in RILA contracts. You might see point-to-point, which simply measures where the index started and where it ended at the conclusion of the segment. You might see averaging strategies that smooth out the index's performance over time rather than relying on a single endpoint. Each has its own characteristics and its own trade-offs depending on how markets behave during the term. But the strategy we want to focus on today is the participation rate strategy. A participation rate defines what percentage of the index's positive return is credited to your contract. A 100% participation rate means if the index is up 10%, you are credited 10%. A 120% participation rate means if the index is up 10%, you are credited 12%. You participated in more than the market returned. This is not a gimmick. It is a contractual feature made possible by the way the insurance company structures its own hedging on the back end. The longer the segment term, the more room there is to offer higher participation rates. And over a multi-year period, even a modest improvement in participation rate compounds into a significant difference in outcome. That is why understanding this feature specifically, not just that participation exists, but how the rate works and what drives it, changes how you evaluate these contracts. The other side of the equation is protection, and RILA contracts offer more than one way to define it. Some contracts offer a floor. A floor sets a maximum loss regardless of how far the market falls. If your floor is negative 10% and the market falls 40%, your loss is capped at 10. You know the worst case scenario before you commit. Some contracts offer a buffer. A buffer absorbs a defined percentage of loss from the top down. If your buffer is 10% and the market falls 15%, the buffer absorbs the first 10 and you experience the remaining 5. If the market falls within the buffer entirely, you experience no loss at all. Both of these are forms of defined protection, but they behave differently in severe market environments. A floor protects you absolutely beyond a certain point. A buffer protects you completely within a certain range, but does not cap your loss if markets fall dramatically beyond it. The buffer is the more commonly used structure in today's RILA market, and for most investors in most market environments, the buffer provides meaningful protection where it is needed most. Severe declines beyond the buffer are possible, but the buffer handles the kind of corrections that historically trigger the most emotional and costly investor reactions. RILAs are registered securities, meaning they carry specific regulations and are subject to disclosure requirements. The terms of every contract are spelled out in advance. Participation rates, buffer levels, segment terms, and any caps or limits are all defined before you commit. Nothing is assumed. That transparency is one of the features that makes RILAs worth understanding in depth. This is just the beginning of this series. Structured notes, buffered UITs, and buffered ETFs are all ahead. Each one carries the buffer concept differently and serves a different purpose in a portfolio. Keep a lookout for more videos that dive into these topics. Beyond the Ticker exists to be a resource you can trust. Subscribe, like this video, and if someone in your life could use this, send it their way. We are grateful for everyone who has found us. See you next time.